Good morning. It's Thursday, the 27th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered usually in Mumbai, India's financial capital. But today is a short edition and I am in transit. So here goes. The take. Public policy and businesses don't talk, and that's a problem. So what will happen if something you need for your kitchen or a bar of soap or amazingly even a PlayStation does not come to you in 10 minutes? Would it be a matter of life and death? Well, clearly not, since we're talking about stuff that you need for daily existence and not life-saving medicines. Now, before I tell you where I'm going with this, here's the news. Reports in the Economic Times says that Reliance Retail has started a pilot for immediate delivery of groceries and consumer products in Navi Mumbai and Mumbai so as to fulfill orders within an hour. Why an hour? Presumably because anything beyond that and customers start hyperventilating. Apparently, Reliance will try and reduce the delivery time to 30 to 45 minutes, which of course could once again make the difference between survival and not, I'm guessing, for many customers. Of course, Reliance is only responding to what it thinks is market demand, which I think is a little foolish, given that Reliance has real shareholders to respond to and is not trying to sell its business tomorrow to a private equity investor. It's surprising that the company would want to enter this game. Of course, Reliance might have well calibrated, as any thinking business leader would, that they could jump into this space now, which is to deliver in 10 minutes or close by, and pull back as soon as the competitors, usually because they run out of funding or customers stopped paying a premium for something that they should have sought actually counseling for, and that market sort of disappears. This is my view, of course. But here's the real problem. Indian Express spoke to some 60 such gig workers who do these lightning deliveries at the peak of Delhi summer, which is of course a few weeks ago. And a third of them said that they had to call in sick because they couldn't survive the 45 degrees Celsius temperatures, which of course people even in air-conditioned rooms complain about. Others said they suffered but could not afford to call in sick. One delivery boy said that in the past 2 months, not a day had gone by when he had not had a debilitating headache at work. And he thought it was because of the sun, but he couldn't take a break, he told the Indian Express. Now, the heat waves may fade away as the monsoons take over, but the gig workers' troubles will not end as they encounter the prospect of delivering in heavy rains. And then there will be bitter cold in the north of India, which will of course be worse in itself than before. So here's the other problem. More people whizzing around on bikes in severely congested urban cities is not a business opportunity, it's a business contributing to urban decay for no real reason. So I'm not against arguing for e-commerce, but I am arguing for some calibration because our cities cannot take this load. And our young workforce, more importantly, and their lives cannot be played with just because we are unable to create other jobs. There are, of course, many manual jobs which pay well and are more calibrated, including in construction. And construction employs over 75 million people in India and also has some safeguards, though only relatively, and there is some protection from heat and the elements thanks to the very nature of the job. The larger issue is also this. Civic authorities like, let's say, City of Mumbai or Delhi have to regulate gig workers in the delivery economy or the delivery companies to ensure their working conditions are reasonable. Second, and also important, civic authorities have to ensure there is some balance in terms of load on infrastructure. Now, this is tough to do, and I'm not saying it's easy, but the opposite cannot be the case, which is that 50 companies want to start delivering in 10 minutes and expose their workers to hazardous conditions, including high density and traffic and pollution, and all because someone cannot wait till the end of the day or for a day for something to be delivered. Some delivery companies have said that they are conscious of climate and will use battery-based vehicles. Now, that's a problem actually no one asked them to solve, quite literally and frankly. Anyway, I hope that we will see some resolve and resolution to this problem. Or, of course, we can hope that the venture capitalists run out of funds, which is optimum too, because that's usually what drives this madness, and only hope that it happens sooner than later. There is nothing worse than a poor business model being flogged endlessly and causing harm to man and environment. And that brings us to our top stories and themes. The markets have hit record highs again as mainline stocks now take charge. NVidia's illustration of volatility and thus dangers of peak markets. Oil prices are worryingly high. And finally, how remittances from overseas Indians are double of foreign direct investment and foreign portfolio investment combined.
This is the Core Report with Govindraj Ethiraj.
Mainline stocks are in charge. So the bull run this time is clearly with mainline stocks, which are somewhat shunned earlier, and now they are in charge. This is also a reflection of how more institutional investors, including overseas, are returning to the markets, as we discussed yesterday as well. Institutional investors also prefer the big and perhaps old favorites for their strong balance sheets, trustworthy managements, and of course, track records, even if those share prices have been subdued in the last year or so for reasons mostly of slower growth. Now, there's something to keep in mind as an investor. When you do the next round of stock picking, that you should be or ought to be distributing between old favorites, even if they appear sluggish, and some new bets which you want to take. The big stocks that moved on Wednesday were companies like Reliance Industries, Bharti Airtel, Ultratech Cement, and of course the big private banks, including ICICI Bank, which has been hitting record highs. Speaking of records, the BSE Sensex touched a record high of 78,759, closing eventually up 621 points at 78,674, and the NSE Nifty ended at 23,869, up 148 points. Interestingly, in the broader markets, the BSE mid-cap was down, and so was the small cap, though that rose about 0.1%, so barely any change. The Nifty has hit record highs in 8 out of 11 sessions, Reuters pointed out, adding that the Nifty has gained about 6% in June so far, on course for its best month this year. Oil to telecom major Reliance, who we just spoke of and who also has the second highest weightage on the Nifty, rose about 4% to hit an all-time high. It's risen about 2% since April 1, though less than Nifty's 7% increase according to Reuters. ICICI Bank has rallied for the 7th session now in a row. So global funds have been net buyers of Indian equities for 10 straight sessions, the longest in a year, according to Money Control, quoting Bloomberg data to say that they've bought about $3.4 billion worth of shares in the period through June 21st. My sense is that they're still net negative for 2024, the calendar year, but we will know with latest figures, which might change and make that into a positive in a few days. Gold prices are now lower. A quick update on gold. Global prices, which also drive Indian, have fallen to their lowest in nearly 2 weeks on Wednesday as the dollar got stronger. Investors waited for fresh cues from the Federal Reserve on where interest rates in the US would go. Reuters reported that spot gold has fallen to about $2,308 per ounce, hitting its lowest since June 14th. What's up on Wall Street? We spoke yesterday of how NVidia was hammered on Wall Street, losing some $430 billion at that point in market value. We've also spoken of how it had begun recovering, and it did almost 7% on Tuesday. The lesson, of course, as we've pointed out yesterday, is that stocks at their lifetime peaks can get volatile even if the fundamentals are strong, as they are in the case of NVIDIA, where chip demand is still looking very, very sound. The Wall Street Journal has been asking and wondering if NVIDIA's stock price rise was bringing back memories, which are obviously not pleasant, of the 2000 dot-com boom. So even if NVIDIA has recovered, and it could and will and could get even stronger, or it might suddenly reverse, we don't know. Meanwhile, the interesting story on Wall Street is this. FedEx Corporation, considered a barometer of economic growth, has jumped about 15% on a bullish forecast, according to Bloomberg. FedEx, as you know, is a logistics company, and the only connection with chips is perhaps that it delivers them. Oil prices are worryingly high. Oil prices were up on Wednesday, nearing their highest level in almost 2 months. Now, forecasts are talking of a combination of factors, including peak summer demand season and geopolitical risks from the Middle East conflict, according to Bloomberg. The American Petroleum Institute on Tuesday reported that U.S. crude oil stocks rose by about 914,000 barrels, and Brent crude oil futures were now up to about $85.46 a barrel on Wednesday. A strong dollar, says Bloomberg, is capping gains as the market remains optimistic of a rate cut before the end of the year. And a stronger currency makes dollar-priced oil more expensive for buyers in other currencies. India is a good example. If the rupee depreciates further, which it's unlikely to do, but if it did, then each barrel of oil would cost much more to buy, as we have to pay more rupees per dollar. India has a specific problem as well, which is that Russian oil, which we were getting at massive discounts starting about 2 years ago, and then it petered out a little after Russia attacked Ukraine and the West imposed sanctions. So now that oil is no longer coming at those discounts, which had hit 16% or so at peak. So, bottom line, our oil bill will rise. Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. Could a weak monsoon affect inflation further? Cumulative rainfall till last week has been below the long-term average, while projections earlier was they would be higher, though the projection, of course, that is of higher or more rains was for the whole season. A report in the Economic Times quotes various economists saying that the stalled rainfall across the majority of the country has led to a delay in kharif sowing. A significant delay in kharif sowing will impact food output and the rabi sowing season, as farmers will have less time to prepare their fields after the kharif harvest. A lot of that is slightly speculative because we would obviously want to wait for more data to come in and the month of June to end. But retail food prices have definitely increased thanks to persistent heat wave conditions. And we've, of course, been talking about food and vegetable inflation, which has been over 26%. Remittances hit fresh records, double of FDI and FPI. Indians residing overseas sent some $107 billion net back last year, crossing the $100 billion threshold for the second consecutive year, according to a report in the Economic Times. Now, the important or the interesting thing is that net remittances are double of the $54 billion that India received from both foreign direct investments and foreign portfolio investments in that same period. The total figure, gross that is, was about $119 billion. After accounting for repatriation of income by foreign residents and other related expenses, the net private transfers came down to about $107 billion. According to a survey by the Reserve Bank of India on post-COVID-19 remittances, the United States is the primary contributor, equaling about 23%. Remittances from the Gulf region experienced a decline during this period. The majority of these funds are for familial support, which is coming into families, with a portion also coming to investments such as deposits, according to the Reserve Bank of India's findings on remittances and also as shown by this report. All in all, good reason for India to be kind to its non-resident Indians and treat them well when they visit. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.